Thank you for checking out Real Talk Personal Finance. Shit's about to get real. Cash Flow King with you today. And today, in episode 11, we are going to talk about life insurance basics. Before we get into the episode, I just want to do a quick couple of shout outs. First and foremost, we appreciate all of our listeners from all over the globe. But there are a couple of locations that came onto the map here recently, and we certainly want to recognize those folks in Nicholasville, Kentucky, as well as Pasco, Washington. So those are two locations that previously did not have any listenership, and they've come in pretty strong here as of late. So just want to give a special shout out to you guys out there. Thank you for listening to the show. Hopefully you like it, and feel free to go ahead and share that with your friends, family, coworkers, whoever the fuck you want that you think would like this show and that isn't offended by a little bit of vulgarity from time to time. All right, so episode 11, Life Insurance Basics. We're going to talk about a whole bunch of stuff life insurance related. This is going to be a general overview, somewhat similar to the Roth IRA Basics episode that I did. I don't know that we'll have an advanced or intermediate life insurance episode. This may be kind of a one and done episode, but if needed, we can also do a deeper dive on some specifics. But I'm going to give you some information from the perspective of somebody that is licensed to sell life insurance, such as myself. It is a fairly small part of my practice overall. However, it is something that is offered, and I'm going to give you my perspective on the good, the bad, and the ugly, and you can make whatever decisions and determinations you may choose to make for yourself. So the first thing that I think anybody really should ask themselves in the context of life insurance and considering life insurance is simply, what do you want life insurance to do for you? And that probably sounds like a loaded question, and you're probably thinking, well, jackass, if I die, I want there to be money there for my beneficiaries. Well, okay, no shit, but there's other things that you can use life insurance for and other reasons that you may or may not want to have life insurance in the first place. And the answer to that question is going to be a little bit different for everybody. I think the one common underlying theme is probably going to be that death benefit protection. If somebody passes away, there's funds there immediately available, income tax free, to go wherever they might need to go. But there are some people that may also want to utilize life insurance for more than just that. And we'll talk about that as we go through today's episode. A couple of things that come up quite a bit, so I thought I would just kind of start with this. One of them is just kind of a general rule of thumb. People say, well, how much life insurance do I need? And that's a loaded question. First and foremost, in some circumstances, you may not need any at all, as a matter of fact. But if you do, the general rule of thumb, depending on who you listen to, will be somewhere in the neighborhood, and this is a pretty wide range, but anywhere from 10 to 25 times income. So if somebody's earning $100,000 a year, 10 times that would be $1 million, 25 times that would be $2.5 million. So chances are that person may need somewhere in the neighborhood of between $1 million and $2.5 million of coverage. Now, that's not going to be the case for everybody. And again, it is a general rule of thumb, kind of like we talked about in one of the retirement episodes, where there's some generalizations as to what percentage of income people may spend in retirement. You might remember that episode previously. I think the best way to really drill down and get at the number is to do a needs analysis and truly figure out how much life insurance somebody might need. And without going through that in excruciating detail, because there's, quite frankly, different ways to do it and there's some subcategories in there, to break it down in the most general terms, you're going to want to look at some things like what sort of liquidity or cash needs might there be up front immediately after somebody passes. What sort of ongoing income needs might there be? You want to make some reasonable assumptions, especially when you're looking at the ongoing income figure. So you may hear some folks in the industry talk about TVM, or time value of money calculations, where we're going to make some certain assumptions, right? If we have a pool of money that falls out of the sky in the form of life insurance, and we need a certain number of dollars per year, if we were to invest the majority of the money and simply pull out a systematic withdrawal or income stream from that particular investment, what will we need to have fall out of the sky today under these certain assumptions as far as investment returns to produce that income stream that we need, and what is the time period upon which we need that income stream. So I know that's a lot, but again, it just comes down to what do I need now and what might I need on an ongoing basis, or more importantly, your beneficiaries, what might they need up front and what might they need on an ongoing basis, again, with reasonable time value of money assumptions. And there's other things that go into that. You're going to want to look at things like existing assets and existing liquidity and other sources. So just because somebody earns, $100,000 a year, let's say, doesn't mean that they're going to be pigeonholed into that $1 to $2.5 million of coverage. If they're worth, say, $10 million, well, maybe you can make an argument. Do they need insurance? Do they not need insurance? Do they have assets to cover what they need or not? So again, you can get very, very granular with this, and that's beyond the scope of today's show. But just understand, in order to get the most meaningful number for you and your family, you're going to want to do some sort of a detailed needs analysis. And you may want to do that with a professional. You may want to go online and try to find some different calculators on your own. I will tell you, even though you want to drill down and get a fairly accurate number, it's okay to round a little bit. So these numbers don't have to be exactly perfect. All right, so going back to the opening question, what do you want life insurance to do for you? For most people, and we're talking about middle America here, those that may be interested in life insurance are going to want funds available to pay for final expenses. So whether that's a cremation or a burial service, some people want to throw a big fucking party, which is actually kind of awesome. I think that's a really neat idea. Maybe you don't want to do it right away when somebody passes, because that's kind of a emotional roller coaster, but maybe there's some funds available at a predetermined time in the future after that where you kind of throw a big celebration in honor of that person. I think that's a pretty cool idea, and something actually, now that I hear myself talking about it out loud, that I might like to have done for me when I'm no longer here. So final expenses. You also may want to look at different types of debt in terms of debt payoff. We've done several shows about different types of debt, and we're not going to go down that rabbit hole today. Some things may need to be taken care of. Other things may go away when you pass away. So any sort of lingering debt that you want to have paid off as a lump sum, you can factor that into your analysis. The most important one, well, before I get to the most important one, the other one, if you have children, and everyone feels differently about this, but you may want to establish some sort of a college fund. That might be enough money to take care of all, say, 4 years, for example. It might be enough to get somebody started. Whatever your views are on that, on college in general, and whether or not you want to pay for your kids to go to college or you want them to have to work and take out loans or whatever the case might be, that's completely your decision. But some people do want to have a chunk of money available for funding college for their kids before they reach a certain age. The most important one that I think is very often overlooked is income replacement. And this is going to be income replacement for not only the breadwinner, if there's a primary breadwinner in the household, but also if, let's say, well, first of all, you might have a dual income household where both spouses go to work, and that's fine. You may also have a household where one person goes to work and makes the majority of the money, but the other one may stay home. And a lot of people, I think this is becoming more and more thought about these days, but for the longest time, a lot of people would not consider the financial value of that person that's staying in the home. Because remember, let's say you're the one that goes out and makes the money and you have a spouse or significant other that stays at home. There's probably still some things that they're doing around the home. They could be watching the kids. They could be doing meal prep. They could be doing laundry. They could be doing a whole host of things that if they weren't physically there to do those things anymore, you would probably have to hire somebody to do them in order for you to keep going out and generating income outside of the household. Just something to think about. Stemming off of that income replacement and factoring that into the needs analysis, that's where that ongoing income need is going to come into place. So you're going to want to be thinking about things like, okay, well, what am I earning gross before taxes? What are my net earnings after taxes to the household? And then how long am I planning on working, and what's my quote-unquote retirement age? And you can sort of plan accordingly and use some of those things to back into that time value of money calculation. So for example, let's say you're 45 years old and you're only planning on working until 60, but not necessarily the traditional quote-unquote 65, 67, or even nowadays 70 plus, then you may have a lesser need than somebody else that's planning on working longer. Maybe that person doesn't have as much in the form of assets, and they are not able to retire at an earlier age. And so if they did pass away, they would need that ongoing income stream for a longer period of time because they were planning on working longer in the first place. So these are just some things to think about. And for most people, again, just to summarize, you have things like final expenses, debt payoff, college fund, and then income replacement. That's what most people are going to want life insurance to do for them. For some people, the same items that we just talked about would apply, but they may also have some additional considerations or needs that they want life insurance to take care of for them. So for example, and this might sound a little crazy to some people, but some people will want it to serve as a cash reserve fund in some way, or an opportunity fund for future investments in a certain way. And we'll talk about the different types of insurances where that may or may not apply here in a few minutes. Creditor protection. If there's somebody that is a high-earning individual in the litigious society that we live in, if they're afraid of lawsuits and other things, they may also look at certain types of life insurance as a safe haven for certain types of creditor protections. They may want loan availability on certain things, for example, the cash value and certain types of permanent policies that we'll get into. They may also want something that for the longest time was not available, but is more and more commonly available today, things like a chronic illness rider or a long-term care type of benefit that's linked to a particular policy. And then finally, there's even some quote-unquote income benefits for those that may get later and later into retirement and maybe they're running a little short on funds. There are certain policies out there that have some features and provisions where you can kick on an increased income stream for a certain period of time. I know there's some contracts out there that will do that for a 10-year period. So for example, if somebody lives to be age 85, which is for a lot of people the quote-unquote life expectancy for the average person, and all of a sudden their retirement assets are running low and maybe all they have left is Social Security, and now they're starting to have some increased medical costs, for example, there are certain contracts out there that will kick on and pay out a portion of that, if not all of that death benefit, accelerate it to them starting at age 85, for example, for a period of 10 years. So they might be able to boost their retirement income if they run short on other assets. So there's a whole host of different things that life insurance can be used for. This is not an exhaustive list by any means. It's quite possible that I could have missed some things. Again, not an exhaustive list, so if there's something that I may have forgot to mention or something else that you're thinking about, it doesn't mean that life insurance can't offer any other benefits beyond what we just described. It's just that these are typically the bigger ones. So let's get into the age-old debate, or I guess description here first when we're talking about life insurance, as term versus permanent life insurance. So if we look at life insurance in two major categories, and there's different subcategories, and we'll talk about some of those briefly. You have term insurance and you have permanent insurance. Some people will make the analogy that term insurance is like renting and permanent insurance is like owning. And when I hear that, I kind of want to take a shower because it just fucking feels like snake oil to me. I don't exactly buy that argument. I could see why somebody would make that analogy, but I don't exactly think it's apples to apples. So what are we talking about when we say things like term versus permanent? Well, before we get into those descriptions, the first thing I want you to know is that people that sell insurance earn commissions. And that's not necessarily a bad thing. If you've ever bought a house before and you used a real estate agent, chances are they earned a commission. Does that make them a bad person? No. Hopefully they found you a very nice house that you enjoy living in a great neighborhood, so on and so forth. So that's great. So there's definitely value there, and I'm a big believer in that people need to be paid their value. But you want to keep this in mind as you evaluate which types of insurance products you may or may not decide to purchase, because the person selling those products to you is earning a commission. And generally speaking, the higher the premium, which is the amount of money that you pay to the insurance company, depending on the type of policy that you get and the underwriting class that you qualify for and the amount of coverage that you purchase and so on, the more you pay, the more they make, the higher the commission. I can tell you as somebody that sells insurance that generally speaking, term commissions are typically dog shit. They don't pay very much. They suck, all right? I can also tell you that permanent policies, and we'll define those here in a moment, the commissions on those are generally a shit ton. And you might expect me to say, well, you must sell a lot more permanent than term. I sell very, 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 very little permanent insurance because it, in my opinion, has to be a very specific case. And there's certain types of contracts that we don't offer that could be good for somebody in certain situations. But I do sell quite a bit of term insurance where the commissions are not anything overly substantial by any means, but I find most often, spoiler alert, that that's what most people need. And you might be surprised to hear that coming from somebody that has an insurance license. I'm also a chartered life underwriter, or CLU, which is a designation that I have in the life insurance area. And most people that work in the life insurance space, that have life insurance designations, and primarily those that make their living almost exclusively from life insurance, will generally almost always sell the bigger commission, higher premium permanent products. Doesn't make them bad products, doesn't make them bad people necessarily, but I think they are often just sold in a way that they shouldn't be. So let's define these real quick. Term insurance, as the name implies, is for a set period of time. It's for a term. So you could buy a term policy, for example, a 10-year term or a 20-year term or a 30-year term. And you can even go somewhere in between. Some companies will offer like a 21-year term or a 17-year term. Depending on what your needs are, you can match up the time frame for a period of time, and that period of time is the term. And that's the term or the period of time when that coverage is going to be in force. It's going to cover you once the policy is issued, and assuming you continue to make your premium payments, right? You can't stop paying on a 30-year term policy in year 3 and expect to get 27 years of coverage for free, right? Insurance companies would be out of business if they let that happen. So you have to continue to pay your premiums. But it provides protection when, in my opinion, you're most fragile. It's coverage when you need it the most, and it's typically gone when you need it the least. So with term insurance, the reality is that the policy likely will not pay out. And therefore, the premiums are generally much less. If you think about it, if you have someone that's young and relatively healthy and they buy a sizable policy, they're going to pay peanuts in comparison to the death benefit. So let's say they had $1 million death benefit, for example, and they're paying very little in terms of premium every month, or if they pay it once a year, typically the less often or less frequent in a given year that you pay, the better deal you're going to get. It's kind of like your car insurance. If you pay it all up front, here's the price. But if you want to pay it monthly, then we might charge you some bullshit fee, a couple bucks a month extra, like a surcharge, or in life insurance world, we call it a modal factor, where we're going to add a little bit to it because, again, time value of money. Insurance companies are very intelligent and they realize this. But anyhow, there's a reason that you can pay a fairly low premium for a fairly large amount of coverage for a period of time. And the reason is because that coverage is probably not going to pay out. But at the same time, if you're the unfortunate person that gets hit by a bus, or you're in some type of accident, whether that's a plane or a car or whatever, the policy will pay even though you may have paid next to nothing in comparison to the death benefit in terms of premiums. You might have only paid a few $100s in premiums, but all of a sudden your beneficiaries are getting a check income tax free for $1 million, and you think, how in the world can that happen? Because it's not that common. And insurance companies are collecting these relatively low premiums from a lot of different people, and it's just a numbers game, right? Law of large numbers. I think for most people, most of middle America specifically, that term life insurance is sort of just a must-have staple, and it's going to make a lot more sense, in my opinion, for most people than permanent. Doesn't mean that permanent doesn't have its place, and we'll get into some examples here as we go through the show, but I think all else being equal, term is going to be what most people are going to need. Unfortunately, if you go into your local life insurance office, that's probably not going to be the policy that you were most likely going to be sold, or that they're going to try to sell you. If you have a good agent, they will. If you have somebody that just wants to make a quick buck off of you and your situation doesn't warrant these other types of permanent coverages, then chances are they're going to try to sell it to you anyway, unfortunately. So permanent insurance. What do we mean when we say permanent? Well, ostensibly, that coverage is going to be in place for life. And there's different types of permanent insurance policies. The one that most people are probably most familiar with is going to be whole life. There's also different types of universal life. So you might have heard of guaranteed universal life, which is becoming less and less popular. You may have heard of index universal life, which is becoming more and more popular, at least it has been in the past decade or so. You may have heard of variable universal life. There's a whole host of different types of insurances. In the Life Insurance Basics show today, we are not going to go through each of those. Feel free to research on your own if you'd like to. but we're going to group them together under the permanent umbrella because generally speaking, those insurance policies will be with you for your lifetime, hence the word permanent. They are permanently going to be there, again, assuming that premiums are paid on these contracts. So the reason that most of these contracts are significantly more expensive in terms of the premium, the money that you pay to the insurance company, is because most of these policies, if not virtually all of them, will pay out at some point in the future. That is, if they're not canceled, which oftentimes does happen beforehand. There's a lot of people that pay a lot of money in these premiums in these types of policies and then realize years later that they don't need them, and then they go and cancel them in some cases, and the insurance company pretty much is off the hook. So that does happen a lot. But all else being equal, assuming you're going to hold the policy for life, then the policy more than likely will pay out, and therefore the premiums are generally much higher on these types of insurance contracts. They can, in certain situations, be considered a good solution for some people. And I'll give you some examples of where that could fit. Again, I don't think this is the case for most people, but for those that are going to say, oh, well, how can you possibly say that? And here's a million reasons why people should consider permanent coverage. My first question is, who do you work for? Because it's probably a life insurance company, and that's probably how you make your living. And then my second question or second point is going to be, well, that's great. We can always make an isolated instance or example of a particular situation, but for the vast, vast majority of middle America, this is probably not the answer. With that said, let's go through some examples of where it could make sense. It could be a good solution if somebody is concerned about their insurability later in life and they want to make sure they lock in some type of coverage today. So maybe there's some health-related reasons or some things that run in their family, and they might be afraid that they may not be able to qualify for coverage later, and they want to go ahead and lock it in now. Well, the first thing I'll say is you could also go ahead and lock it in now, but lock it in with a term policy. It doesn't have to be a permanent policy, but if for some reason in your mind, and I can't tell you how many people I've talked to, it's just really mind-boggling to me. These are people just in middle America that for whatever reason find this enormous amount of comfort knowing that they're going to have a life insurance contract that pays a death benefit out to their beneficiaries when they pass away, and it's with them forever. Now, on the one hand, I can see why that's comforting. On the other hand, I think very few people realize exactly what that's costing them, and it's very frustrating. But anyway, I digress. Let's continue here. So concerned about insurability later in life and you want to lock it in. Okay, fine. Maybe, and this is kind of one of the dual purpose or secondary considerations of somebody that wants to use life insurance, not just for the death benefit protection, because first and foremost, if anybody buys life insurance, it should primarily be for death benefit protection. You should have a life insurance need where somebody relies on your income, and if you were to pass away, that will cause an economic loss or a financial loss that needs to be absorbed and covered. But aside from that, there's some people that want to implement some sort of investment component with insurance. And you'll hear different terms for this out there. Oftentimes it's referred to as infinite banking or be your own bank or bank on yourself. If you ever can't sleep and you want to go to YouTube and type some of those things in, you'll see a whole host of different people talking about different types of strategies like this. And there's books out there on it if you really get bored and you want to read some books on the infinite banking concept. But there are some people that want to also use life insurance for investment purposes. But again, I think it's a very, very, very small number of people where that could make sense. First of all, in my opinion, if somebody's going to do this quote-unquote infinite banking concept, and by the way, this is not something that I sell or that I promote. I've never sold an infinite banking policy to any client. We just aren't set up for those types of contracts, but they do exist out there. But let's say somebody qualifies for very preferential underwriting. So they are just running marathons, super healthy, don't smoke, maybe even don't drink or drink very little, no medications, no major surgeries, no nothing crazy going on. And they are just super healthy and they can qualify for a very good underwriting class. Well, that's great for everybody, but specifically in this type of policy that's going to be a permanent contract, where the premiums are going to be higher, you all the more want to make sure that that's the case. So they could be in that situation. They typically want to have an agent that's going to design the policy for them to actually, believe it or not, and this is going to sound counterintuitive, but minimize the death benefit, which is the amount that's paid out, or also known as the face value that's paid out to beneficiaries, and maximize the cash value that resides in that policy. And again, I don't think I mentioned this yet, but term insurance, those policies do not have any cash value or any other fancy benefits. Typically, they may have some child riders and some weird shit, but they're not going to have cash value. Permanent contracts generally will build cash value. All contracts are not equal. Each of them, I should say, are going to be set up a little bit differently. But in this case, if you're using it for this purpose, you would want to have it designed for minimum death benefit, maximum cash value, and you really typically want to have gobs of money to throw at this thing. Like I'm talking $10,000 to upwards of $100,000 plus per year in premium, money that you're pumping into a contract like this that you're going to use then later, the cash value portion of it, for investment purposes. Most people cannot afford to put anywhere from $10,000 to $100,000 or more into life insurance contracts. Again, one reason why this isn't for most people. The other one is most of these policies, even though somebody may tell you they're trying to design it this way, they're not actually designed this way, because when they are, the commissions that go to the agents are going to be minimized. And what agent wants to voluntarily minimize their own commission? Probably not too many. And then finally, on this infinite banking concept, these are typically people, a lot of real estate investors. I know people personally that have these infinite banking contracts, and I've actually looked at some of the illustrations that their agents have given them and kind of gone through it, and it can make sense for certain types of investments. But these are typically going to be people that are investing in non-traditional types of investments. So we're not really talking about the stock market. We're talking a lot of times about certain types of businesses or certain types of active real estate investments where they can implement what I like to call the velocity of money principles and keep the money moving. It's essentially, without going too far down this rabbit hole, because we spent way too much time on this already, what they're essentially doing is building up the cash value in these policies, taking a loan against them. That loan is accruing at simple interest, right? Their cash value is typically earning at a compounding rate. So that's the first level of arbitrage. And then they're taking those borrowed funds and deploying them into certain types of non-traditional investments. And a lot of times those investments are cash flow related, where they can use cash flow from those investments to pay back that policy loan. Sometimes if they're flipping or doing something like that, they can put the money in really quick at a really low borrowing cost, do what they need to do, extract the value out, pay the loan back, still have some money left over, and move on to the next thing, so on and so forth. So again, I know people that do this. It can work in very, very specific situations. It's not something that I do personally. It's not something that I've set any clients up with to do, because we're not set up for these types of contracts at our company, but it is something to be aware of. So that might be a reason that somebody might consider certain types of permanent contracts. Next would be business owners that have partners and they're wanting to fund some type of buy-sell agreement. So you may have a small business with several partners. What happens if one person passes away? A lot of times permanent life insurance can be used in an instance like that. Maybe somebody wants to transfer a large amount of wealth, income tax-free. And kind of a sub-example of this would be, especially with some of the new rules with the Secure Act that passed on beneficiaries for certain types of retirement plans. If you look at IRAs or individual retirement accounts, for example, some people, especially older clients, they might not necessarily need the money that they have accumulated. And generally, the rules have changed on this as well. But as of right now, here at the beginning of March of 2022, most people are starting to take required minimum distributions, or RMDs, from most types of retirement plans at age 72. Well, what happens if they're still, and this is going to sound weird, but relatively young, because a lot of people would tell you that, 70 is the new 50. They're 72, relatively young. They don't need the money, and they're generally going to do one of a couple different things with it. They're going to spend it. If they need to spend it, well, in that case, they needed the money. They're going to save it in today's rates at pretty much next to nothing at zero, or they're going to redeploy or reinvest it into something else, some other type of investment, or whatever the case might be. So what some people will do and have done in the past is they'll take these minimum distributions. They will use that to pay the premium on a new life insurance policy, and they'll take fairly small amounts of dollars in the form of premium payments and buy fairly large policies in the form of death benefit amounts, so that when they pass away, and let's say their beneficiaries inherit their IRAs, for example, those beneficiaries will also inherit that life insurance policy, that death benefit amount, the face value, income tax free. Well, why is that important, and how in the world are we making the connection here? We're talking about life insurance, we're talking about IRAs and RMDs. Like, what the fuck, Cash Flow King? What are you talking about? Well, with the Secure Act, there are certain types of beneficiaries now that have to liquidate the account over a 10-year period. So let's say you have a client that is a lot older. They've retired. They might be in their 70s or even in their 80s, but generally we're not doing these in their 80s. But you could look at somebody in their 70s, for example. Their adult children might be in their 40s or 50s, and typically they're still working, and generally they're going to be in their peak earning years, which means they're making a shit ton of money. They're probably paying a shit ton of taxes, and the last thing they want is mom or dad passes away, and now they inherit this big-ass retirement account, and they have to liquidate the thing over a 10-year period, which if it's a traditional IRA and it's pre-tax money, is going to cause them presumably to pay a whole bunch of taxes. So what's one way to sort of deal with that, or one little idea or strategy? If you do some planning, you might consider, or the parents in this example might consider, buying the life insurance policy so that the kids now have the income tax-free death benefit from the life insurance policy to then turn around and handle and pay for the taxes on these inherited IRAs, for example. Just a small example. There aren't a ton of people that do that, but it is something that I think a lot of people don't think about, because a lot of times they'll say, well, yeah, I'm healthy, and yeah, I'm just going to take the money and put it in the bank and leave it to so-and-so. And generally that's their kids, or they're going to reinvest it into something else, which is going to generate more taxes for them. And then, so it's a way to efficiently try to transfer wealth, or if nothing else, take care of some of those accounts that are, as some people in the industry like to say, are infested with taxes if they're pre-tax accounts. So that's another example on a wealth transfer comment there, bullet point about why somebody may want to consider permanent insurance. And then the last one, and quite frankly, so far, other than the buy-sell for small businesses with partners and the one that I just mentioned, so I guess there's a couple of these that I would agree with, but this one in a big way is going to be for living benefits. And so you might have a life insurance policy where you want some type of chronic illness or long-term care related benefit. A lot of people back in the day would buy traditional long-term care insurance. And for a lot of people, that just became unaffordable. When that was first priced, insurance companies didn't really understand what their claims history was going to be, because they didn't have any claims history. So they grossly underpriced the products. Then they started to see what their claims were looking like, and then said, oh shit, we have to raise premiums on everybody. And I've seen clients that have had long-term care insurance contracts that they bought a while back where they're getting premium increases of 20 to 30%. And I had one client in particular that was like, can we shop this out again? And we looked at it for them, and we did. And what they had was better than anything else that was available on the market. And since then, things and the costs on those policies have gone up and up and up. And one of the downsides is the insurance company on a long-term care insurance contract can raise the premium on a class basis. So if you're, let's say, preferred non-tobacco, for example, you don't smoke, you're in pretty good health, and they decide they want to raise premium amounts on everybody that happens to be preferred non-tobacco, well, tough shit. It's not like they can single you out as an individual, but they can look at the underwriting class and make that determination. And a lot of companies have either been doing that or getting out of the business and so on and so forth. And so now, with a lot of these life insurance contracts out there, they can add these different features or riders onto the contract in order to cover some of these types of expenses later on in life if they should come up. So they can do what's called accelerate that death benefit. Normally, people think about life insurance and it's like, okay, I die, somebody gets paid, right? But this could also be something where if I die, somebody gets paid, but if I'm living and I need the money and I meet certain criteria and I have a policy that has certain riders like this on there, then I can start to spend down some of that death benefit while I'm living out of my own policy. And then when I die, most of the contracts, whatever's left, that's what their beneficiaries will get, if anything. And if there's nothing left, they don't get anything. But if there is something left, then they get the difference. So that's something that's kind of neat. That's relatively, I don't want to say new, but it's been around for a little while now, but it's becoming more and more discussed as of late. And there's different types of riders, and there's different costs and different types of policies. There's ways to do kind of a one and done type of thing. There's ways to do it on an ongoing basis. Again, all that stuff is beyond the scope of today's show. If it turns out, if people want to send feedback into the show, I am going to ask, I guess I'll ask now, but I was going to ask at the end of the show, if anybody has any ideas or suggestions for future episodes and what you'd like to have covered. If that is of interest and we get some emails to that effect, then we may do sort of an intermediate concepts or just a completely separate show on a particular topic and do sort of a deep dive. But for today's show, I'm going to kind of just really stop it there. Just know that there are certain types of permanent life insurance that exist where some of these benefits can be added on there, and a lot of people just aren't aware that that's even a thing. Like a lot of people will have contracts that are a lot older. And most of the time, if you have a contract that's been around for a while, it's probably best to keep it because it's probably better than whatever else is in the market. But this would be an example where that's not necessarily always true because there's some features and benefits that simply weren't available back then that are available now. So if you or somebody you know is kind of going through that or thinking about those types of things, it may be something to consider. And by the way, I know I'm all over the place here, but the feedback, if you have any on show ideas or just the Q&A stuff, email address is realtalkpersonalfinance@gmail.com. Again, that's realtalkpersonalfinance@gmail.com. Okay, so that's the meat of the show. I'm going to go through a couple of examples that I might get a little bit heated here because they kind of piss me off, and then I'll close out with a few comments. But so far up until this point, we've talked about what do you want life insurance to do for you? And we went through what most people want, which is final expenses taken care of, debt payoff, maybe a college fund or two for the kids, income replacement of some kind. That's most people. And then some people also want some additional shit, like using it as an opportunity or cash reserve fund. That would be for the permanent policies, creditor protections, loan availability for the infinite banking stuff we talked about, chronic illness or long-term care benefits like we just talked about, and even some of the income benefits that we mentioned where there's some contracts that will pay out way, way later in life if somebody, quote unquote, lives, too long, which is kind of a weird thing to say. So the real question is, okay, that's what we talked about so far, but all these other benefits, at what price? All that stuff comes at what price? And so as we've said a few times now, permanent contracts are generally going to be much more expensive than term contracts. And for most people, when they're most fragile, they're relatively young, they're trying to maybe raise a family, they're working, they have not accumulated a lot of assets yet, they don't have a lot of passive income yet, and they're at their most fragile point. Maybe they have student loans, they have a mortgage, now they have kids, they want to send the kid, all this stuff is going on. That's when they need the coverage the most. And quite frankly, for a lot of them, that's when they have the least amount of money. So it kills me when I see people that are getting sold a bunch of bullshit that we'll get into that they don't need. I think for the vast majority of those people, term insurance is going to be great. You don't have anything fancy. You don't have any of the fancy benefits we talked about. There's no cash value. There's no infinite banking. There's no chronic illness or long-term care or any of that shit. It's just, hey, if I get hit by a bus, my family gets X. And that X, if I've gone through the needs analysis that we talked about at the beginning of the show, will cover what we need. And it's going to be fairly affordable because chances are it's not going to pay out. But that's okay. We kind of want that to happen. We want to hopefully live a long, happy, healthy life. And so by the time we get to the end of that term, whatever that number of years might be, 20 years, 25, 30, whatever the number is, in that needs analysis that you come up with, okay, great. Now, in that 20 or 25 or 30 years or however many years, we've saved, we've invested, we've accumulated assets. We're closer to retirement. The kids are grown and college is figured out. And a lot of the need for life insurance that we had previously when we were most fragile financially may no longer exist. And that's the time when those policies typically go, bye-bye, right? The term's over. That, in my opinion, is a great solution for the vast majority of people. Now, let's skip ahead here. So we did, what do you want life insurance to do for you? We did term versus permanent. Now we're going to get into how most permanent policies are sold. So about a month ago, and I took note of this, I was just shocked when I heard this. There was another financial podcast I was listening to. I don't like to promote anything really other than Costco. So shout out to Costco. Get yourself a chicken bake. If you don't know where that reference is coming from, I think it's episode 4 with Cube Crusher. There's an episode about retiring at 40 with 5 principles featuring Cube Crusher. So if you didn't get that joke, feel free to check out that episode, which is also one of our top episodes, along with the recent one that we did with the Travel Queen on travel hacking with credit cards. Anyway, quick side note. Anyway, don't like to promote, really anything on the show. This is supposed to be for education, entertainment, and I try to keep it as general as possible to the extent that I can. But on this other show, there was a girl, or somebody had wrote into the show, and there was a girl paying $160 a month. She was 29 years old, 29. She was paying $160 a month, or $1,920 per year, for a $130,000 whole life insurance contract. So if you remember back to term versus permanent, this is an example of a permanent type of contract, whole life insurance. And I just couldn't believe it. First thing I thought was, what the fuck is $130,000 going to do? Okay? If, let's say, I could go off I mean, I'm already going off, but I could go on forever about this. But first of all, if she's 29 and they didn't really get too much into her, at least if they did, I don't remember because I was so just flabbergasted and just wrote this down. I was taking notes and I probably didn't go back to listen to the rest of it. But 29-year-old paying $160 a month for $130,000 worth of coverage just blows my mind. Well, $130,000 on the one hand sounds like a lot of money. And on the one hand, it kind of sort of is a lot of money. But from a life insurance standpoint, if you're 29, unless she's just one of the pioneers of the FI community and she's going to retire next year at 30 because she has all kinds of cash flow and income and assets and everything else, then chances are she's going to work for a while. And if she's buying life insurance to protect dependents, whether that's a spouse or a child or whatever the case might be, and she's going to work presumably until traditional retirement age, but even if it wasn't traditional retirement age, let's say she was going to work till she was 50, right? That's 21 years. I don't know what she was earning. Let's say she was making 50 grand a year. Right? If you do 50 grand a year times 21 years, you're at $1,050,000 right then and there. What in the world is $130,000 going to do? Now, I understand for those geeks out there are going to say, well, wait a minute. Just because she was going to earn $1,050,000 over the next 21 years doesn't mean she needs $1,050,000 in life insurance coverage. Well, no shit. That's where the needs analysis and the time value of money calculation comes into play, where we make assumptions like, all right, well, if we had that money fall out of the sky, or how much money will we need rather to fall out of the sky to invest at a certain rate of return to generate an income stream that would be equivalent to, I get that, right? We don't have to go down that road. But the point is, $130,000 at the age of 29 is not going to do shit. But $160 a month at the age of 29 can do a lot. And that money could probably be better spent elsewhere, right? They didn't get into too much detail on the policy, but chances are she could buy more than 10 times that coverage for a price, for that price or even less than that at a time when she probably needs it the most. She's certainly young. If she's buying life insurance, she probably has other people that rely on her financially. So I would assume that maybe she's married and that maybe she either has started a family or is planning on starting a family, right? There's a lot of things going on there. And she probably doesn't have all the money in the world. And I think the reason she called into the show was because she realized, well, I don't really know if I need this. And maybe it was kind of stretching her budget a little bit. So anyway, same $160 a month, just a quick aside here. If she invested that for 30 years at a 7% average annual rate of return, which is fairly aggressive, but for a 29-year-old, she could probably do better. And we've talked about different rates of return for different types of investments on the show before. We've at least alluded to it. And I think that's a fairly safe assumption for a stock market-based return for somebody that has a fairly aggressive portfolio. If she did that and got 7%, she's going to have over $208,000 anyway, which is over $78,000 more. And that's just in a stock market type of investment. And by the way, if she put that into a Roth IRA, some people say, well, yeah, if she invested it and then she died and then it was, an inherited IRA and then her beneficiaries are going to have to pay taxes like the previous example that you talked about. Well, maybe. But what if she listened to the show, Roth IRA Basics, and last one on Roth IRA Intermediate Concepts, and she said, well, shit, one way or the other, I'm going to do a Roth IRA. Well, guess what? All the money in that account is tax-free. Now, there's no guarantee or certainty that she's going to earn a particular rate of return or that money is actually going to be there. But chances are, in all likelihood, she's going to have a lot more money than she would if she just pissed it into, in this case, this whole life contract. So stuff like this just burns me up. I've seen a lot more egregious examples of it. This one isn't all that bad, but it's just like, really at the core, what is that going to do for you? And I've had people that even I know personally that say, well, I have this whole life contract, and if I have it for so many years, we can loan against it at 0%. Okay, well, that's good, especially when I get into my next example about the loan interest rate on a solicitation that I personally got. That's fine. But is that really a reason to pay 10 times more for the life insurance than you need to pay? Do you really want to pay 10 times more in premiums for a coverage amount that isn't going to do shit just because somebody gave you a little sizzle pop and said, hey, you can take a loan at 0%? Well, you can get loans. We've talked about collateralizing assets on previous shows. There's all kinds of ways to do things at fairly low rates, especially in today's environment. And I don't think that's a reason in and of itself to just jump and say, oh, well, this is great. If I can loan at 0%, I'm going to put all the money I can in here. It sounds like a decent feature, but let's look at the bigger picture. What do we need? What type of coverage do we need? How much do we need? And what's the premium going to be that we're going to pay? And then what are some of the other ancillary benefits, if any, that we're going to get for that? And is there a better way to accomplish the same goal? So the second example here is, as I just mentioned, a solicitation that I got. This was actually an email, and I printed it out here. And this is also on TV, and it drives me crazy. It's a Gerber Life Insurance email solicitation. And let's see, I'm going to read this quote from it here. It says, start your child or grandchild with a $5,000, $10,000, $15,000, $35,000, or $50,000 whole life insurance policy and lock in a child-sized premium that will never increase. Your little one will get the big coverage he or she needs with the small premium you want. Okay. Why the fuck does my kid need a life insurance policy? And more importantly, what in the world is $5, $10, $15, $35, or $50,000 going to do? If they need life insurance, buy some fucking life insurance. Buy a policy that covers something. And I know that sounds terrible, and you're probably like, oh my gosh, Cash Flow King's going off the rails today. But it's like, my goodness, people, like, actually get some coverage that you need. $5,000 isn't going to do shit. You can charge whatever little quote-unquote amount of premium that you want. But at the end of the day, if the policy value on the other end of that is negligible and it doesn't have a meaningful economic or financial impact on your life or the life of your loved ones, then what good is it, right? It's crazy. And speaking of loan interest rates, at the bottom here, there's a double asterisk, and it says policy loan interest rate is 8%, yada, yada, yada. So I just don't understand this. Some people, I've had a couple clients over the years have talked about getting life insurance for their kids, or somebody got them, one of their parents probably got the same fucking solicitation and was a sucker and bought it. But I don't know. I don't get it. I would never do it. I would never suggest that anybody else do it. I cannot think of a situation where that's going to happen. Obviously, if a child were to pass, it's devastating. And there's going to be a huge emotional component there, right? You're not going to be the same. It's your kid. But at the same time, if the insurance company gives you $10,000, is that really going to be anything meaningful to you to the point where you want to start paying on a life insurance policy while they're an infant? So stuff like this just burns me up. I just don't understand it. The fine print, they call it a children's whole life insurance policy. I don't think most adults need whole life insurance, quite frankly. I certainly don't think that any children or infants need a whole life insurance policy. And in my opinion, you're just pissing money away on something like that. So I actually saved that. I printed that out about a month ago. I knew I'd be recording the show at some point, and I saved it for this show. Let's see. Final thing here, you've probably heard this before, maybe not. But the acronym I think a lot of people use is BTID, Buy Term Invest the Difference. And so the idea, which I really resonate with this, and again, it sounds kind of crazy coming from somebody that is able to offer life insurance to people, but I'm a big believer for those that are disciplined, not everybody is, but for those that are or are able to become disciplined, you buy term while you're young and you need it the most for a fairly cheap and inexpensive premium. You then invest the money that you would otherwise piss away on most types of permanent products that you probably don't need at that phase in your life. And you have the coverage that you need the most while you're also simultaneously building long-term wealth through those additional investments, right? The whole buy term, invest the difference, I'm a big proponent of that. The other thing is, the way I see it, you can always evaluate permanent policies later in life for some of the other reasons or benefits that we mentioned that you probably don't need in your 20s, in your 30s, in your 40s. So if, as we were going through some of the stuff, you're like, you know what, the whole idea about wiping out taxes that might be due on a traditional IRA, that's a cool concept. Or, yeah, the living benefit thing's kind of cool. What if I do need some type of chronic illness coverage or long-term care type of coverage later in life? All that stuff is fine. There's just no reason to spend decades, in my opinion, overpaying or essentially prepaying for that when you can just buy a term policy now for what you need and evaluate your financial situation and everything else later in life. And if at that time it makes sense for you and you have the resources to do so and you want to get a permanent policy, in my opinion, that is generally the time to do it. Again, with a few other exceptions that we talked about earlier in the show. So that's kind of the life insurance basics on episode number 11. Again, shout out to all the listeners. Thank you very much for being part of our audience. That's what keeps me going and wanting to record these. I have a blast doing this, right? I'm not trying to really monetize the podcast yet. I don't know if I will at all. I think on the travel hacking episode, I mentioned, hey, throw us a bone and send an email if you want to get a card. We'll hook you up and we'll get a little bonus point off of it. You're not going to get anything less because of that, and it's a win-win for everybody. Just kind of a thank you type of thing. But I don't have ads on the show right now. I don't have sponsorships. I'm really not trying to do any of that shit. I really truly do this because it's entertaining, I think anyway. I'm trying to add value and educate. I've got a lot of positive feedback for folks that do listen to the episode pretty religiously. And, it seems like every time I turn around, there's new cities and states popping up, and in some cases, new countries popping up that are listening to the show. So it's pretty good shit. I love it. Hopefully you do too. Last plug, I'll say, like I've said in all the other episodes, if you have a question that you want to submit for an upcoming Q&A show, you can do that anonymously. Or if you have a show idea, I've not asked about this before, but if there's a certain topic that you want to hear about on the show, or something that we kind of scratch the surface of on a basics episode like this, on life insurance basics, and you want to hear more about it, if I get enough feedback that enough people want to hear about a specific topic, then maybe we'll do a separate show and do a deep dive. So any of that, feel free to send an email to realtalkpersonalfinance@gmail.com. Again, that's realtalkpersonalfinance@gmail.com. Thanks again for listening to episode 11 on life insurance basics. We will see you in the next episode.
Check the mic and make sure it sound right, boys.